So we're continuing on with chapter 9, talking about tax credits. We already went through, what did we go through? We went through the education credits, the credit for the elderly and disabled. What was the first one? Do you remember?
Child care.
Child dependent care credit. Good job. Now we're moving on to the foreign tax credit. Here, hold on a second.
Thank you.
No problem.
Well, people out there in the hallway.
Are there? I don't think they're. Oh, it's not here. Is she the only one? Looks like. No. Also. All right. So, moving right along here, we're going to talk about the foreign tax credit. So, when individuals have income that is from a foreign source, oftentimes, so we're talking here, I mean, it could be all sorts of different types of income, right? It could be income from earnings, you know, or like wages. If they worked overseas, it could be interest income. Maybe they have a bank account overseas and that bank account earns interest. Maybe they have property overseas and they are renting that property and they get income from that. So all sorts of, any type of income that you could have in the U.S., you could also have from other sources outside of the U.S. Well, remember, U.S. taxpayers are taxed on their income from whatever source derived. So whether it's domestically or internationally, all of that income, unless it's specifically excluded, would be taxable. Now, in order to try and abate double taxation, the IRS does, or the U.S. tax code does allow for a credit toward U.S. taxes, amounts that were already paid to foreign governments. So for example, if you have rental income, say you got a house in Paris, you got an apartment in Paris, lucky you, and you rent that out as an Airbnb and you receive income from that rental property. Or you're living here in Iowa, but that house, when it receives the rental income, you also have to pay taxes in France on that income. But you also have to report it as income here in the U.S., so you've reported it in two places. What the U.S. allows you to do is to take a credit against that same income here in the U.S. that you've already paid tax on overseas. So there are a couple of different ways, and if you recall when we went through the Schedule A, we talked about a deduction for other taxes. So for state and local taxes, but you were also allowed a deduction for any foreign taxes that were paid. And that could be on like property taxes, maybe that home that you're renting it out, it's gonna be attached to a Schedule E. But let's say you have some other home overseas and you're paying property taxes on it, you're allowed a deduction for that. Now, this one, if you have paid income taxes, now this is going to be income, taxes on income, not necessarily the property taxes, that would be a Schedule A deduction. But sometimes the income taxes could be deductible on the Schedule A, or they could qualify for the foreign tax credit. Now, like any other deduction versus credit scenario, 9 times out of 10, the credit is going to be more valuable than the deduction on the Schedule A as an itemized deduction. So most people would take this, although there are some instances, rare instances, where it would be better for individuals to take the deduction for those same taxes that have been paid. You can't double up. You can't take a deduction for it on the Schedule A and then use the same taxes that you paid toward a credit on the foreign tax credit, but you could, if they're different taxes, you can take both. But so this foreign tax credit, again, this is to help mitigate the double taxation that can occur. Now, it doesn't necessarily always 100% mitigate it or eliminate it, but it reduces the effect of it. So there is a calculation to figure out how much the credit is, and it has to do with the proportion of foreign income that you have to worldwide income that you have. So we would take our foreign source taxable income divided by our worldwide taxable income and multiply it by our US income, our tax liability before the foreign tax credit. So whatever we would be paying before that foreign tax credit would be the that amount. So we've got our foreign, I'm just gonna say income, divided by worldwide income times our US tax liability. And this is again before, ooh, I don't like this. FTC. And this gets us to our foreign tax credit. Now this is the limitation. We'll do an example here. All right. Kim reported worldwide taxable income of $84,010. So there's our denominator, 84,010. Included $1,000 of foreign source interest income. All right, so her foreign source taxable income is that $1,000. That's our numerator. Her U.S. tax liability was $18,273. She paid foreign taxes of $250 on the foreign income. She's entitled to a tax credit of $218. Even though she paid, this is one of those examples where it's not 100% going to mitigate it, because the U.S. tax rate is higher than whatever, the foreign tax rate is higher than what the U.S. tax rate is. So the U.S. isn't going to give you credit for a higher tax rate than what the U.S. imposes on it. So multiply this times the 18,273? They did the math here, right? It's $218. I'm assuming that their math is right. This is our foreign tax credit limitation. So she paid $250 in foreign tax on that. She's going to get a credit of $218. Now this is going to be limited to the amount of foreign tax that she paid on it. So if she paid $200 in tax, this would be $200. She can't get a credit for more than the tax that she paid. And again, that's a dollar for dollar. So she does get a credit toward that. So she's not paying tax. She's sort of paying tax twice, but it's because the tax rate in the foreign country is higher than the tax rate here in the U.S. So, what are they saying here? So normally what we would use is this form, it's down here, this form 1116 to claim the foreign tax credit, but there's certain times when we don't have to use that form 1116. So if all of the foreign source income is passive income, now you have to meet all of these requirements, by the way. So passive income, so it's not earned income, right? So some sort of investment. All of the income and foreign taxes are reported to the taxpayer on the appropriate 1099. Now, oftentimes, mutual funds, if you own a mutual fund, remember we talked about what mutual funds are. They're a conglomeration of stocks. Oftentimes within those mutual funds will be stocks from foreign companies. And as part of that, the mutual fund itself is having to pay foreign taxes when they cash out when they realize some gains, they may have to pay foreign taxes as part of that. So you may have, if you own a mutual fund, you may have a percentage of that foreign tax that you get to then claim as a credit. If that's the case, and it was reported on a 1099, that would meet one of the qualifications for not filing the 1116. Excuse me.
So,
Yeah.
you can go back a little bit. Yeah, for the homework, for this example. Because I'm seeing in a quiz, it says includes 8,000, 10 includes 1,000 or well, for myself, I'm very white man. I don't understand because it's include. So you can make a subtraction or you can give me the worldwide formula is equal what?
So, I don't.
Yeah, because the worldwide taxable income is 84, yeah.
Included in that is the 1,000. So their domestic income would be 83,010. Their total income would include that 1,000. And that's what we're gonna use as the denominator, all of it.
So the foreign source and inside in the worldwide income,
Mm-hmm.
okay.
Does that make sense?
Oh, it does make sense.
Okay. And if you wanna go through that, I mean, we can go through
Yeah.
some problems as well, if that helps. Excuse me. So if that's the case and that those foreign taxes were reported on a 1099, then that would meet one of the qualifications. Now normally, well, if it's foreign taxes, like in my example where it was income taxes that were paid on a rental property, that's not gonna be reported on a 1099, right? That's completely separate, so then you would have to file this Form 1116. Total foreign taxes paid were less than $300, $600 if married filing jointly. So it has to be a small amount of those taxes. And the taxpayer is not subject to foreign tax limitation rules, which we're not gonna go through. But as long as they meet all of those requirements, then they wouldn't have to file the Form 1116. And we'll take a look at that in just a second, what's involved in that. So cash basis taxpayers, which is every individual taxpayer, take the foreign tax credit in the year that the taxes were paid, not when they were assessed, but when they were paid. They can make an election to take the credit for all foreign taxes in the year they accrue. Now you could take an election, but it would have to be for all of the foreign taxes. A lot easier if you just wait until you've actually paid them. Taxpayers may also choose to deduct foreign taxes as an itemized deduction. That's what I was talking about early on the Schedule A, rather than as a credit, but it is usually not advantageous to do so. Usually it's better to take the credit. Now, I had actually a client that we took the deduction rather than the credit. He was an airline pilot and he flew for a couple of different airlines during the year. He flew for one, he's American, but American, US airlines have very strict rules about once you reach a certain age, you can no longer fly commercially. Other countries don't have some of those rules. So he was flying for a Chinese airline for a while, and then also for in the Caribbean somewhere that he was flying. So he had a lot of foreign taxes that he had paid. And he was wanting to make certain retirement contributions. He wanted to max out his retirement contribution as well. When we went through all of the calculations, it turned out that if he took the foreign tax credit, it would reduce the amount that he could contribute toward his retirement, as opposed to if he had taken the deductions. Kind of a convoluted calculation, but we put both of them together, and for his purposes and what he wanted to do, we took the deduction instead of the foreign tax credit. But that's a very specialized instance. Normally, taxpayers are looking at reducing their taxes right now, and so in that case, 9 times out of 10, this is going to be, the credit is going to be more valuable than any particular deduction. Let's see. What else do I want to say here? Oh, they talk about a couple of other scenarios as well, where it might be advantageous to do that. Joy has 63,000 of worldwide taxable income, which includes 8,000 of taxable income from New Zealand. She paid 2,500 in foreign income taxes. Her U.S. tax liability is 17,640. So in this case, we're going to take. You guys are going to have to get out your calculator because I don't have mine with me. So 63,000, 8,000 of taxable income here, and she paid. Her U.S. tax liability was 17,640. So what's the calculation there? $2,240. So that's her foreign tax credit, $2,240. Okay. If it was, so she paid, even though she paid 2,500 in foreign taxes, she's only going to get a credit on her U.S. taxes for 2,240. This is the Form 1116. You'll see up here we've got check boxes for the type of income that we are reporting. So passive income, which is what it's generally going to be, it would be box C. And then we have the calculation down here. Now the first question on, or line, I guess it's I, is the name of the foreign country or U.S. possession. Now sometimes if it's on a mutual fund, it's going to probably be multiple foreign countries. So you don't put those down separately. It would just say various up here. So multiple countries. Gross income from sources within that country, shown above. So that's our foreign income. There's our numerator. So if this is from compensation for your personal services as an employee, your total compensation, blah, 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 blah. So this is if you were, there's an alternative method of calculating it if you're a high earner and it was over that amount. You can also deduct expenses that are directly related to that income as well. So that's what these deductions and losses are. I don't think you guys really have to do too much with any of these. Expenses directly related, itemized deduction, standard deduction. We don't do anything with that. Gross foreign source income. No, it's up there. So, oh, that's for the deduction, sorry. I don't think you guys do anything with this in your homework. Okay, and then we get down to the taxes paid or accrued. So you've got a box here, choice, was it paid or was it accrued? That you can choose. Usually it's going to be paid. The date that it was paid, that the amount that was paid, if it's dividends, royalties, or rent, how much tax was held. If it's in the foreign currency, if it's listed in the foreign currency, you'd list it here. In US dollars, you'd list it here on this side. Much easier to calculate if you're using it in the US dollars, if it was paid in US dollars. If it's not in US dollars, you're going to have to do a conversion to US dollars based on the date that it was paid. And then the rest of the calculation here. Let's see. Enter the amount from line 8, which is here. So this would be the total foreign taxes that were paid. Any carryover of foreign taxes, so if there was an amount from the previous year, I think there is a carryover for that. Did they talk about that here? I can't remember how long that is. They don't really talk about how long that is, so I don't think we know anything with that. Lines 9 and 10, so the amount of foreign taxes paid here. Don't worry about the reduction. Don't worry about line 13. This would be, so line 14 would be the amount that's on line 9 and 11. Because we're combining those. Enter the amount from line 7, which is here. here, so this is the income that's listed. Whoops. And then the calculation that we have here is listed here. So combine the amounts, this is your net foreign source taxable income. If it's 0 or less, you have no foreign tax credit for that category of income that you checked above. So you could have multiple 1116 forms because you have different types of income, foreign earned income, right? So line 15, we are going to be limited to our taxable income here. So it's not a refundable credit. This is a non-refundable credit, so it can't bring you below 0. Okay? I'm trying to think if there are any other lines that you'd have to fill out. So individual, so line 18 here is going to be the taxable income from 1040. Divide line 17 by line 19. Okay. This here. If it's more, enter 1. So it's more than 100. I don't know why it would be foreign income worldwide. I don't know why that would be more than 1. I suppose. Line 16. This is the tax liability. U.S. tax liability. Here is line. I'm sorry, line 20. Line 20 is going to be that tax liability. Multiply by line 20 by line 19, which is our proportion here. That gives us our limitation. So all of that step by step on this form as well. Questions? No? Not too